In Chapter 5, we talk about something called cost volume profit analysis. This is an approach to decision making based on our understanding of how costs behave. And so what we're going to do to form the basis of this actually is work with the contribution margin formatted income statement that we covered in the first week of classes. And so toward that end, I've put an abbreviated income statement here in this file where we have sales of $150,000, variable costs of $90,000. That gives us a contribution margin of $60,000. Remember, the contribution margin is the difference between sales and variable costs. It's the amount available to contribute toward covering your fixed expenses and generating profit. Then we have fixed expenses of $50,000, leaving us with net operating income of $10,000. Then over to the right, I have included the per unit data down to contribution margin. Keep in mind, per unit data for fixed expenses is less than relevant since fixed expenses by definition remain the same regardless of the level of activity. So again, this is a similar example to what we went through in week 1. We're using a volume of 3,000 units. So the sales of 150,000 divided by 3,000 units gives us a sales price per unit of $50. The variable cost divided by 3,000 units gives us a variable cost per unit of $30. And then the difference, of course, is our contribution margin of $20 per unit. So I've summarized down here a couple of pieces of data. One is that contribution margin per unit. Remember, this is a pertinent piece of information because this tells us that for every additional unit that we sell, there's $20 going toward either covering the fixed expenses or generating profit. Now, we can define contribution margin in another way as well. We can define it as a ratio. This would be a ratio of sales. So I've calculated it at 40%. I calculated it a couple of ways. One is I took the total contribution margin of $60,000, divided it by the total sales of $150 to come up with 40%. You can also do that on a per unit basis. So I took the $20 contribution margin per unit, divided it by the sales price per unit of $50, and still came up with 40%. A lot of it depends on what data you have available to you. So, a couple of things I want to talk about on this particular worksheet. One is the break-even point. The break-even point is the point at which we neither are generating profit nor are we generating a loss. We are literally operating where our expenses equal our sales. And that's a really important piece of information to have at your ready, because that tells you your minimum amount of sales that you need to make in order to not generate a loss. So there's a convoluted explanation of break-even point in your book that walks you through a fairly lengthy derivation of an equation. I like to think of it in very simple terms, keeping in mind that your contribution margin per unit contributes toward covering your fixed expenses, and your contribution margin minus fixed expenses equals net income, net operating income. As long as you're generating enough units to cover your fixed expenses, you're going to break even. So what I use to calculate break-even point is just a very simple equation wherein I take my fixed expenses, in this case $50,000, and divide it by my contribution margin per unit of $20. So for every unit that covers 20, that I sell is going to contribute $20. This will tell me how many units I need to sell in order to cover my $50,000 in fixed expenses. And what it is 2,500 units. So my break-even point is 2,500 units. I need to sell at least 2,500 to not be in a loss mode. Now you will see I did another calculation as well. I took my fixed expenses and divided it by my contribution margin ratio of 40%. That gives me my break-even point in sales. So I can either sell 2,500 units or I need to generate $125,000 in sales revenue. Now, if you take your 2,500 units and you multiply it by your sales price per unit, guess what you're going to get? $125,000. So there are just two ways at arriving at the same data. It depends on how you want the data. Do you want it in dollars or units? And what data do you have available to generate the break-even point? Now, you can use the same information and the same approach to determine how many units you need to sell in order to achieve a targeted net operating income. Keep in mind that contribution margin per unit, once it has covered your fixed expenses, is going to generate profit. So let's say we have a targeted net operating income of $25,000. Then the number of units that I need to sell to achieve that will have to achieve that and cover my fixed expenses. So I have an equation that is my fixed expenses plus my targeted net income. That becomes my numerator. And then my contribution margin per unit or contribution margin ratio is my denominator. And what we can see is I need to sell 2,500 units to break even. If I want to achieve $25,000 in targeted net operating income, then I need to sell 3,750 units. And then below this, I've just done the same calculation using the ratio to arrive at the amount of sales, which would be 187,500. One last concept before we leave this particular worksheet, and that is the margin of safety. The margin of safety is in essence the difference between your sales, whether they're actual or budgeted, and your sales at break-even point. So in our example, we are currently achieving sales of 150,000, and we calculated our break-even point as being 125,000 in sales. Therefore, the difference between those is our margin of safety, in this case, $25,000. This can be very useful because it tells us, in essence, what cushion we have, how much our sales could drop before we go into a loss mode. So it can be a very useful piece of information to know what that margin of safety is. On this worksheet, now that we've kind of gone through the basics of break-even point, contribution margin per unit, etc., I want to walk through some examples of cost, volume, profit analysis. Think about the term cost, volume, profit analysis. In essence, what this allows us to do is look at different scenarios from a what-if perspective. What if our sales price goes up? What if our costs go up? What if our sales volume goes down? What is the impact on our profit going to be? And it's this understanding of the variable versus fixed and the contribution margin that helps us do this. So I'm using the same income statement that we dealt with in the previous example with an assumed current sales volume of 3,000 units. And I'm going to walk us through three different scenarios. Okay. First scenario says, If we decrease our sales price by $2, we could increase sales by 15%. Should we do it? Well, we need to look at what will change if we decrease our sales price. In reality, if we reduce our sales price by $2, our contribution margin is going to go down by $2. Keep in mind, contribution margin per unit, sales price minus variable costs. If the sales price goes down, so too will the contribution margin. So with the lower price, they're saying we can actually increase our sales by 15%. So 3,000 units increased 15%. We would wind up with sales of 3,450 units. So what's our new contribution margin going to be? Well, that will be 18 at 3,450 units, or 62,100. Our current contribution margin is 60,000, which means our contribution margin will go up by $2,100. And notice in this particular scenario, we are not assuming any changes in fixed expenses, which means that increase in contribution margin will go all the way to the bottom line, increasing our net operating income, which would imply that, yeah, this is a change we should make. Now, keep in mind that when we look at these quantitative changes, we also have to think qualitatively about the likelihood that this will happen. So our marketing department has told us, sure, if we've got a lower sales price, we can definitely sell more. What if they're wrong? Well, if they're wrong, then obviously this scenario will not turn out as positive as it appears to. All right, let's look at another one. Scenario 2. If we increase our variable cost by $3, the quality of our product will increase, and therefore our sales will go up by 25%. Should we do it? Well, again, what is our revised contribution margin going to be if we increase our variable costs and leave our sales price alone? We're going back to the original assumptions. Then our revised contribution margin will now be $17 per unit. So we'll be contributing less on a per unit basis because we're spending more in variable costs. Now, our sales will go up by 25%, so they will now be $3,750. That will leave us with a revised contribution margin of $63,750. Again, comparing it to our current contribution margin of $60,000, it increases, and that increase will all go to the bottom line. So, yes, on the surface, we should do that. Now, let's look at one last scenario. And let's say, in this one, we're going to increase our advertising costs, which is a fixed cost, by $20,000. Our marketing department basically says we don't have enough advertising out there. We're not well known enough. And they think if that happens, our sales will go up by 25%. Okay, first thing to note, does our contribution margin per unit change? The answer is no, because the only change we're making here is to fixed costs. Our sales, however, will go up by 25% to $3,750. So our revised contribution margin will be the increase in sales times the current contribution margin per unit of $20. We compare that to the current one, which is the $60,000, and we're going to have an increase in contribution margin of $15,000. However, what has to come out of that increased contribution margin is the additional $20,000 in fixed costs. Once we do that, what's going to happen? Our net operating income is going to decrease by $5,000, which basically says no, that increase in fixed expenses will not increase our sales enough to even cover the increased fixed expenses, much less increase our profit. Now, note, I did a change in sale price, a change in variable cost per unit, a change in fixed cost. We could combine those. We could have had an increase in sales price, a decrease in fixed variable costs. We could have had an increase in sales price, an increase in fixed costs, any combination thereof, and we can go through this same analysis. The other thing to note is I could have just gone in and prepared a new income statement with the new criteria and come up with a new bottom line. But we don't have to. If we understand the behavior of our various costs and we understand our contribution margin per unit, we can determine the impact of these changes without going through and preparing an entirely new income statement. Merely all we need to do is look at the changes.